So Martin, what do you think is the biggest risk to the markets right now?
I think probably geopolitical and obviously the China-US situation is probably the biggest threat that could see a slowdown, especially in the Chinese economy. But I think we shouldn't overreact to that because even if there were no exports, the Chinese economy would still grow at 5% a year on domestic growth. So it's still pretty resilient, and most countries would love to have a 5% growth rate.
And even with the China-U.S. trade war, how do you think Trump is playing it? Is he doing a good job?
Yeah, I think he's probably doing a reasonable job. I think the tax situation I think was good. The tax cuts were good. I think most people probably think there was an imbalance. So I think he'd quite like to do a deal though, and not let this stretch out too long. Because he is someone that likes to get a result, so he's not in for a long campaign, I don't think.
And do you think that we're headed for another financial crisis?
No, I don't think so. But I mean, the stock markets are telling us one thing, and the economists are telling us another. The economists are telling us that world growth will still be 3% next year, but the stock markets are saying there's going to be a slowdown, probably slower than that. And, stock markets are good forward indicators.
So who do you think is right? Do you think
I think the markets are usually right, but it's probably a slowdown rather than a recession.
So how do you invest in that kind of environment? Where are you seeing opportunities?
Well, I think the great thing for a business like ourselves is we're seeing a sort of return more to our style of investing, more value, more quality, and more active. So active fund managers and value fund managers have had a really tough time for 3, 4, 5 years. But the last 3, 4 months have been great with good outperformance numbers. So hopefully, talking about our own book here, we return more to what I would term traditional fund management.
And what asset classes do you like right now versus which ones are you worried about?
I think I still prefer equities because you're getting you're getting a really good yield on a lot of equities, especially UK equities, which are unloved at the moment because of Brexit. So you're being well paid at the moment just to wait and for a turnaround.
And what are the two likely outcomes for the Brexit, and how will that impact UK
I
equities?
still have the view that a deal will be done, as it always is, the night before the deadline. So I think that's the most likely outcome.
And what's your 2019 outlook for U.S. equities?
I think you always you ignore U.S. equities at your peril, and for us outside the U.S., we've always tended to be underweight. But the U.S. market and the economy is incredibly resilient, and the companies are incredibly resilient and tend to do much better than a lot of people think. Plus, there's a lot of cash. They're buying back stock. Now, I know there's an argument you should be investing it rather than buying it back, but investors like to have the cash back if the company doesn't have a use for it.
And how do you think the Fed is doing?
Yeah, I think it's okay. I mean, I think it'll be more cautious in the first few months, first 6 months of this year, just to make sure there isn't a dramatic slowdown in the U.S. economy. But the good thing about the Fed is it's got ahead of the game, I think, rather than behind the game.
And do you care about the shape of the yield curve at all? Does it worry you?
Yeah, I mean, I'm old, and I've seen these yields are sort of like 200-year lows in the UK. So to me, this is totally alien, and I've never seen the yield curve like this. So I'm cautious when the yield curve is such that it would require you to invest in a 30 years out or whatever it is to break even. So negative real yields are not something I would advise people to invest in.
And what about your book keeps you up at night?
Always the same, keeping your talent, really world markets. Although I've learned not to worry about the markets because there's nothing you can do there, but just worry about the things you can have an influence on. So So really, just make sure you keep your team, and run the business as efficiently as you can.
And from a leadership perspective, you have a co-CEO. How does that work? What makes you guys stronger or weaker?
I think it works. It's worked incredibly well because it allows us both to concentrate on our strengths. So for me, I always enjoyed the client side of the business, and Keith is an economist. I'm an accountant, so he's always enjoyed the economics and the actual day-to-day fund management. So we have complementary strengths, and I think it's worked. Really, really well.
Great. And from an asset management perspective, what trends are you seeing in the industry?
Well, I think, the last 4 or 5 years, we've just seen the index guys sort of powering ahead with QE. Hopefully, with the slowdown or ending of QE, we might see a more return to active investing and long-term investing. So that's what I'm really looking at. I think there is definitely a trend more long-term. Also ESG. These sort of factors are coming through from the asset owners to us, the asset managers.